Here's the tough question. Why are we up today? Earnings guidance has been lousy in the last 24 hours. And folks, it is earnings guidance. Don't worry so much about fourth quarter. We're trying to figure out 2019 numbers because this is the time of year they introduced the 2019 numbers. And in the last 24 hours, it hasn't been very good. But look at the markets. Look at the sectors. We're up today. Industrials, many of whom did not report very good guidance or give very good guidance, generally up. Energy's up a little bit. We finally got oil up a little bit today. Materials are up. Banks are up a little bit. Consumer discretionary is weak because Harley and Whirlpool, not good guidance there overall. So let's just quickly look at what I call disappointments. 2019 numbers that were lower than even the lower expectations we started in 2019 here. So Pfizer was below expectations. Put up the next full screen. 3M. Lowered guidance there, and a lot of people say, oh, well, it wasn't as bad as people were afraid of. Okay, fine, but it was still down. Lockheed, Whirlpool, Harley, all lowered the numbers overall. It wasn't awful across the board. A number of companies gave in line or better guidance for 2019. So Verizon was about in line, for example. Rockwell Automation, that was pretty good. Dover did better, gave better guidance. Packard gave better guidance. Xerox gave better guidance. So it wasn't a complete mess overall, but there's a very clear trend emerging right now for earnings trends. So we're a quarter of the way through. We got 135 companies of the S&P 500 reporting, and this is what we see. For the fourth quarter, there were fewer top and bottom line beats than there typically are. The earnings growth rate was slow. Remember we talked about 24% earnings growth in the first three quarters? Well, it's down to about 14 in the fourth quarter. But the important thing is the 2019 guidance, and the trend has been down. We are not at zero. We are at about 5% growth and about 2% for the first quarter. But we're getting lower. What the markets really need, if you want, in my opinion, we need a global activity to pick up because that's the biggest drag on earnings overall. That's the big issue right now. But wait a minute. All this crummy news and the markets are up. Why are we up on such poor earnings guidance? There's a couple of things going on. Number one, it's the day before the Fed meeting, and we have this infamous trend called the Fed drift, where the market tends to go up in the 24 hours before the Fed meeting. I have said this many times. This is a well-studied event. The Federal Reserve itself has acknowledged this. So that's maybe a factor here. Fed and central banks are remaining dovish, and the market is coming to believe that other central banks around the world not only are not going to raise rates, but may even add stimulus if they have to sometime in 2019. Of course, there is optimism on China trade talks, despite all of the caution that's out there. The market believes that some deal can be made. Maybe that is foolish or not, but that is clearly in the markets right now. And as I mentioned, we need global activity to pick up a little bit here. So bottom line here is let's take a look at earnings right now for the first quarter. That's where we care about. 1.8% is today's number. It's been steadily coming down. We were at 8% October 1st. 5% on January 1st, 1.8%. And you see it's just sort of drifting lower every day. Whether we go negative or not is where a lot of people are debating, where the dividing line is. Do we get an earnings recession, 2 consecutive quarters of negative earnings growth, or do we stay in the low single digits somewhere around there? And again, a lot of this is going to depend on global activity picking up. But for the day, everyone believes so far that things are going to work out. We're up 73 points on the Dow.